Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with the 5 o'clock shadow and with the NMLS number 2028201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
Feels like it's been a while. Which I think it has, actually, because I did a show on Wednesday, and I think that was it. So it's almost been a week. Probably going to be a little rusty, so bear with me. But welcome, everyone, to the Tuesday edition of Wilmington Mortgage. I am the aforementioned host of this podcast, Tyler Cralle, of course, loan officer at Town Bank Mortgage, right here in Wilmington, North Carolina, where we break down the top stories impacting mortgage rates right here in Wilmington. Usually national stories, or in today's case, international. We got a global bond sell-off that is really impacting, I don't want to say really impacting mortgage rates, but pushing rates up. That's what's going on here. And it's a little complicated. I mean, I got kind of confused trying to figure this out myself today, so I'm going to keep it as simple as possible for my own brain because I'll get lost in what I'm talking about. But we got, essentially, Japan's having some problems. Japan is having issues, and we are, unfortunately, getting sort of taken along for the ride, unfortunately. So the main reason why is Japan is having some political turmoil. Well, actually, no, it really hasn't, actually. Okay, hold on. I'm already confusing myself. So here's what's going on. So Japan's new prime minister, who was elected last year, surprise election that she won, Sani Takeachi, I think I'm saying that right, Sani Takeachi, called a snap parliamentary election to start the week to shore up support for her agenda. You see this in parliamentary elections. You can do this stuff to try and make sure that you lock in your support. And what she's trying to do is, so she's already spending a lot of money. So she's already added, I think, $783 billion, or a record budget for the next fiscal year. And now she wants to add to that. And she's going to add to that by suspending an 8% levy on food for 2 years. So that's one of the ways they're bringing in revenue, which Japan needs to do because Japan has an epic debt load, 240%. That is their GDP, or their debt to GDP ratio. To put it in context, the United States, who has a ton of debt, is at 120%, which is close to all-time highs. I think we're right around where we were in World War II. But we're getting up there, and they're double us. And that's because, Japan really hasn't had much of an economy for the last 25 years. So if you remember in the 80s, we all just watched Die Hard because that's a Christmas movie. But it was very it was a good representation of the 80s. Everyone thought, because remember the owner of the company that John McClane's wife works for is working for a Japanese company. And if you watch every movie in the 80s, everyone thought Japan was going to take over the world. And then all of a sudden, just brick wall. And the economy just didn't grow for 25 years. The great stagnation is what happened to Japan. But they have been spending. They've been spending a lot of money. And now they're in a very kind of scary place. Now, what's funny is that they have so much debt. I mean, so much more than other developed nations. You would think that there'd be concern with investors out there, right? Someone's I don't know if I want to buy Japanese. There's a lot of Japanese debt out there. And, I guess there's the possibility they could default or something. So maybe I'm not going to buy it. And so normally when that happens, yields rise because then people are going to say, you know what? It's a riskier investment. I'm going to need more yield. I'm going to need a higher rate of return to justify putting my money in Japan. And yet bond yields are pretty low. I mean, for example, the 10 years, half what ours is. So why is that happening? Well, it's because the Bank of Japan is artificially lowering their interest rates. Bank of Japan is buying government debt in order to keep their borrowing rate low so they can actually afford their debt, because they would not be able to. I mean, think about us, for example. I mean, so we have like what, $1 trillion payment every year in servicing debt. That's how much it costs us. And I mean, if it was $2 trillion, we'd be having some problems. And so, mind you, their debt load is double ours. And yet, for some reason, their interest rate's half of ours. So they're actually paying significantly less than they should be. So the Bank of Japan's buying up all this debt. And this is a problem. Robin Brooks, who has a great Substack, wrote about this in November, saying the Bank of Japan's heavy buying keeps yields below where markets would otherwise price them. The side effect, a sharper, weaker yen. And Brooks even noted that the currency slide has put it nearly on par with the Turkish lira, one of the worst performing global currencies. Because if you remember, Erdogan, the leader of Turkey, essentially disbanded the central bank and just started giving everyone money. And inflation there has like skyrocketed. So the lira is like one of the worst performing currencies. And the yen is not far behind. That's not a good comparison to have. And this matters because, I mean, Japan is the largest foreign holder of U.S. debt, $1.2 trillion of debt that they hold. $9 trillion is owned by foreign investors, and Japan is $1.2 trillion. So it's like, 20% of all foreign holdings are held by Japan. So it's a significant amount. So if something bad happens in Japan's economy, it could impact the United States. But really what this is about is sort of a reckoning for what's been happening in the developed world for 20, 30, 40 years, which is just these massive amounts of debt that we've been able to sort of handle, but we're reaching kind of the upper limit of our ability to handle these debt loads with rising interest rates. And so Brooks, once again, writes in that November piece, we're in the early stages of a global debt crisis. Longer-term yields are rising as investors grow increasingly concerned that massive debt burdens will ultimately be inflated away. The result is a frantic search for safe havens, the so-called debasement trade, that has pushed precious metals sharply higher and suddenly made low-debt countries like Switzerland, Sweden, and Denmark far more attractive. In short, patience is wearing thin with governments whose primary answer to excessive debt is simply to spend more. And that's kind of where we are. I mean, everywhere. I mean, even the U.S. I mean, we had that Doge experiment last year, and everyone said, "Oh my gosh, they're cutting everything. Oh, it's going to be the way." And like at the end of the day, it was like instead of a $2 trillion deficit, we had a $1.95 trillion deficit. And I mean, it's not just the U.S. I mean, the U.K., Germany, I mean, France, Italy. I mean, a lot of these countries have kind of sort of stable debt loads. Like they can't continue on this pathway. And so, I mean, this has been going on for a while. But what's happening in Japan is probably what's causing an issue for all these other sort of economies that are in similar situations. And so, like I said, I mean, it's not like we have to worry that, oh my gosh, we're going to be the next Japan. I mean, it's kind of like the ghost of Christmas future where we should be like, we don't want to be like that. We don't want that to happen here. So we should keep an eye on it. But this could end up correcting itself. But if you do want to know why rates were up, and it wasn't, like crazy number, it's because of that. I mean, so for example, once again, the 40 years at the highest level ever, the Japanese 10-year is up 20 basis points in 2 days. That's at the highest level, 2.375%, the highest level since 1997, when I was a freshman in high school. And I'm now 44 years old. It's been a little bit of a while. The UK 10-year was up 21 basis points over the last 4 trading sessions. And the German Bund was up about 8 basis points over the last 4 sessions. So if you want to know, that's what I was trying to say. If you want to know what is happening, that's it. And this could easily be corrected tomorrow or by next week. But that's why rates are rising, is you're starting to see some uncertainty in global appetites. And mind you, this is also happening with other concerns. So we have this possible escalation or this escalating trade war with Europe. President Trump over the weekend, not happy with the way some European countries are reacting to his play for Greenland. So he's threatening tariffs. They're threatening to throw away the trade deal that they've been working on. And so that in itself is also sort of magnifying some of these debt issues in some of these developed nations, where investors are like, all right, I'm just getting out. We're going to go put our money in metals or crypto or just something that is not directly impacted by these geopolitical headwinds, tailwinds, whatever, however you want to describe it. And Ray Dalio was on CNBC Monday morning or Tuesday morning, and he said that, President Trump's aggressive political direction could trigger a new phase of global financial conflicts, prompting foreign governments and investors to rethink their appetite for U.S. assets, saying, quote, on the other side of trade deficits and trade wars, there are capital in capital wars. And so that's kind of the second part of the story, is that like if it was just Japan, you'd probably see some upward rate movement, but it's also sort of the uncertainty of what's happening with Europe and the implications that's going to have going forward with sort of the whole world. I think is also maybe making people a little worried. Now, what's, normally when there's concern about economies, people tend to run to bonds. So this tells us that there is this sort of falling appetite for U.S. assets, that you're seeing these bonds rise. Because like I said, if there was a concern, people would be like, oh man, we better go to the biggest economy and park our money there and secure those, buy those bonds and secure those yields. And the fact that they're like, maybe not. Maybe we're not going to do that. It's like, oh, okay. So there's an issue with some of these developed nations and people wondering about our fiscal house and whether or not it's in order. Like I said, we're much better off than Japan. Japan's got some issues. I mean, Robin Brooks is basically like, a reckoning is going to be happening in Japan. And, once again, Japan holds a bunch of foreign debt, so a bunch of our debt. And so if something were to cause them to need to sell that debt, or if you see all these U.S. traders have to unwind those yen carry trades, I mean, it could be an issue. It could impact bond yields. And so it's not just yet. I think this is more sort of premature moves. Like, oh, maybe it might happen, so maybe I'm going to unwind this 10-year position, but that's what's going on. Hopefully that made some sense. I kind of confused myself on that, but basically global stuff is messing with our bond market. There we go. I did that in 10 seconds. I didn't even need my notes. That will be in the newsletter, though. All right. I think we're going to call it a day. So you guys enjoy the rest of your Tuesday. We'll see you back here Wednesday for another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. You buy real estate and wait.